Hello, everybody. My name is Todd Martin, and thank you for joining our webinar series. We'll show you what's possible. Today we're going to talk about stop loss. So, what is stop loss? Stop loss is a type of insurance that the majority of self-funded employers purchase to protect them against catastrophic risks, such as high dollar claims. And when you think about stop loss, think about it like when you purchase your own health insurance for yourself or for your family. The higher the deductible when you're open enrollment and you're looking at your benefit options is typically the cheapest. And the reason that is because the higher the deductible, the more risk you are assuming as the individual. So the higher the deductible, the more exposure the individual has to paying claims. And so therefore, the premium is going to be lower than a lower deductible plan. And so stop loss really works the exact same way. The higher the deductible that the employer chooses, the more they're on the hook for claims, but the less that they will pay in premium. So there's two types of insurance. There's specific insurance, which is on each individual member of the plan. So the employer is responsible for funding up to the deductible level. And then once that member hits that deductible level, the insurance carrier will pick up the remaining amount. There is also aggregate insurance, and aggregate insurance really protects against the plan's overall claim spend. So, specific and aggregate coverage. Specific, typically the lowest that you can go in form of a deductible is $10,000. Now, larger employers, they will have higher deductible amounts because they typically have more cash flow. They're bigger organizations. Smaller employers, they're going to have lower deductibles, which means they're paying a little bit more on premium, but they know that their exposure to claims is going to be relatively lower. On the aggregate insurance, that is really protecting the employer against overall claim spend. So if I had a $50,000 deductible and 100 employees, and I had $49,000 in claims on every individual, I would have no specific coverage because nobody hit that $50,000 specific deductible. That's why people buy aggregate insurance. It's very rarely needed. Oftentimes people refer to it as sleep insurance because typically 10% of your population will be driving 90% of your costs, and that 10% will actually be having the specific deductible kick in. So what should I consider when purchasing stop loss insurance, right? One is really the biggest thing is your risk tolerance, right? Like how much can I absorb in terms of paying claims for each member on the plan? If I'm a really, really cash heavy organization, I have really good cash flow, we're growing every single year, I would probably lean towards a higher deductible level. But if I'm an organization that's maybe strapped for cash, the demographics, aren't exactly friendly. So maybe it's an older population incurring more high dollar type claims. I might pick a lower deductible level. And honestly, in those situations where claims experience is really high and your demographics getting older, maybe self-funding really just isn't a fit for your organization. So let's take a look at an example. So Market Madness, they're a company with 200 employees. Some of the employees have chronic conditions and suffer from unexpected health issues. Market Madness purchases aggregate stop loss insurance. And so the way that aggregate stop loss insurance works is that the employer assumes some responsibility of the claim. So if I want to use round numbers, if I'm an underwriter and I take a look at a group's claims experience, I might project out that I think this group is going to have $1 million in claims this year. Now, with aggregate insurance, there is a corridor that the employer is responsible for covering. That corridor is 25%. So if I'm an underwriter and I'm looking at a group's claims experience and say, you want to know what? I think they're going to have $1 million in claims this year. Then the aggregate insurance would not kick in until the employer covers that 25% corridor. 25% of $1 million would be $1,250,000. So the aggregate insurance would not kick in until the employer spends $1.25 million. And in the example of Market Madness that you see here on the screen, if their expected claims is $2 million, then the aggregate insurance truly won't kick in until $2.5 million. Now, Mark, he works at Market Madness. He's diagnosed with a rare form of cancers. and Mark's treatment is extremely costly. And so in this instance, this is where we'll really see more of the use of the specific deductible. The specific deductible is really chosen based upon usually the size of the group. In this instance here, Mark's claims are $125,000 to treat his rare cancer. Now, if Market Madness has a specific deductible of $50,000, then that means that Market Madness would be responsible for funding the first $50,000 in claims towards Mark's claims, and then the remaining $75,000 would be picked up by the stop loss carrier. Now, one of the terms that you might oftentimes hear is laser. And so stop loss is really for the unknown risks. The unknown risks are things that just pop up, right? We don't foresee them coming. Now, if we know that Joe is potentially going to have, say, a kidney transplant, right? Kidney transplant could cost $300,000. In the instance of Market Madness, they might laser Joe at $300,000 if Joe has that kidney transplant. Now, Market Madness has a $50,000 specific deductible. So now if Joe has a kidney transplant and it costs $300,000 and the laser is for $300,000, now the employer, Market Madness, they're going to have to come up with 100% of those claims. So a lot of times people hear about lasers and they get scared, but only about 1/3 of lasers are ever actually incurred. What that means is about 2/3 of lasers never even happen. And so in the instance of Joe and his kidney transplant, in the fully insured world, they're going to assume that that risk and that potential claim could be coming every year when they offer their renewal. And so every year they're going to be building in this risk of the $300,000 kidney transplant. Now, it's very possible that Joe leaves employment. It's very possible Joe gets his condition taken care of with medication. So if the kidney transplant is not incurred, then the employer obviously won with that laser. Now, if they were in the fully insured space and that kidney transplant was never incurred, well, it was accounted for in the underwriting, so the employer truly paid for it. The carrier is not going to come back and give them money and say, hey, you want to know what? That kidney transplant was never incurred. So you want to know what? Here's $300,000 back. So lasers are truly for known potential risks and exposures to the stop loss carrier. They're often very specific to a unique individual as well as a unique condition and potentially procedure that they could receive. So underwriters, they're always taking a look at the data. So they always want to see 2 or 3 years of historical claims experience. They want to know, has this group been running well? Are they historically a group that runs very poorly, where they have a lot of high dollar claims? And so they're taking a look at things like the overall health and well-being of the organization when they're reviewing that claims experience. Are they a group that has a lot of chronic conditions, a lot of high dollar claimants on an annual basis? Or are they somebody that's relatively young, relatively healthy? They take a look at things like industry, regions of the country. Obviously, demographics play a big part into underwriting, but that's why every group is unique in their own way. So the underwriting process, typically, we're gathering claims experience, we're sending it out to different stop loss parties, and they're taking a look at that claims experience, and they're basically taking a look at what is the potential for claims in the coming year. And they will provide us with a proposal for stop loss. Different types of deductible levels. Larger groups typically have higher deductible levels. Smaller groups have lower deductible levels. And then they set a premium and they essentially, share a proposal back to us. The nice thing about stop loss is we can market stop loss and change stop loss every single year, but that's really on the back end. That's protecting the catastrophic risk. It doesn't mean we have to have a disruption or open enrollments because we're changing networks, we're changing benefit plans. We can change stop loss carriers every year, and the employees, they don't feel it, they don't see it, they have the same ID card. So that's one of the great things, about self-funding. And so why does this all matter? It helps employers manage their healthcare costs in a fair way, in a balanced way. It also keeps the stop loss carriers, I guess, honest, because every single year we go out and we market these carriers and we make sure that we're getting the most competitive prices for our clients. Because at the end of the day, that's how we're really going to help control costs. And so I appreciate everybody taking some time to learn about stop loss today. Feel free to follow us on our socials, or even feel free to reach out to me directly. My email is tmartin, TMARTIN, @novahealthcare.com. Thank you and have a great day.